AI is the most powerful technology shift in our lifetime.
NVIDIA also hitting a fresh intraday high. That's today's leader.
As oil once powered industrial growth, semiconductors, they're now fueling the AI boom. So right now, the market is placing its bets accordingly.
It's transforming productivity, making advancements in science and medicine, changing the way we do business, and rewriting the rules of investment. Now, some people call this the fourth industrial revolution. If you've been following the news at all, you would have come across seeing NVIDIA, the company that makes all the GPUs that power these AI models, have hit $5 trillion this cycle. To gain an appreciation for how large $5 trillion of market cap is, if we take a look right over here, you can see that NVIDIA is now larger than the GDP of all of the countries in the world except for the US and China. And these companies continue to capture upon this success and grow at such a large magnitude and scale. During this cycle alone, we now have more than 498 companies that are worth $1 billion or more, and 1,300 companies that are now worth over $100 million. So the Mag 7 companies, Tesla, NVIDIA, Amazon, Apple, Alphabet or Google, Microsoft, and Meta, they actually put in $1.7 trillion of revenue in 2024, making up 36% of the S&P 500. Now, to put that in perspective, every dollar that you put into the S&P 500 or an index fund, likely 36 cents to 40 cents is actually going to an AI company. So our economy, our stock market is dependent upon AI for growth as of this very moment. And NVIDIA's $5 trillion market cap value is worth more than the entire stock market of Italy, the UAE, Spain, and the Netherlands combined. But here's the truth of what most people don't see. A huge portion of this AI boom is fueled by this circular money machine, a feedback loop between the AI companies, cloud providers, and chip makers that's starting to look dangerously like a bubble. But it's not exactly a 2000.com copy and paste, but it's something bigger. So in today's video, I just wanted to break it down further and understand who the AI players are, where's the money coming from, explain a little bit of the circular financing loop between the AI companies, the debt that's hidden on their balance sheet and out of sight, and then finally, how could we use this information to make informed decisions going forward? So to get a really good understanding and grasp of this story, we first have to understand all the different AI companies that are involved. Now, group number one are the chip makers. So these are the giants like NVIDIA, AMD, and Intel. They make some of the most advanced chips within the world that run the AI companies and the computational models that are out there. Think of them as the shovel sellers in the previous gold rush era because they sell the GPUs. So in this case, these are the picks and shovel that will help all of the different AI companies, the mainstream AI companies, to run all of their different AI models. Then there's group number two, the data centers, the cloud and infrastructure people. So these are your Microsoft, your Amazon, Oracle, and CoreWeave. We call them the middlemen, the capacity builders, because these companies buy those GPU chips, they build up massive data centers, secure gigawatts of power, and then finally rent out compute to those AI companies. So you can think of them as the middleman of the AI economy. They are the capacity builders. And then finally, group number three, these are the mainstream AI companies that you hear about all the time. So things like OpenAI with ChatGPT, xAI with Grok, and Google DeepMind. So what these AI companies do is they buy a large amount of compute from the clouds, burning through hundreds of billions of dollars, trying to run their AI models, always pushing the frontiers of their AI models into the next level. By doing so, all of these companies compete against each other, spend hundreds of billions of dollars by trying to become the top AI model. And the thing that results next is a major explosion in the CapEx spending across all of the board. So the CapEx spending between most of the Mag 7 companies have now exceeded $330 billion in 2025 alone. And the race has gotten so heated, they become blind and burn through billions of dollars. You can see right over here, Mark Zuckerberg, the CEO of Meta, said that he'd rather misspend hundreds of billion dollars than be late to this superintelligence party. And true to their words, Meta plans to spend $60 billion a year. Google earlier announced they would spend $75 billion on AI, and then later on this year, they just recently announced a $40 billion investment into a new data center in Texas. And Microsoft followed up with $80 billion, and then Amazon saying they'll spend more than $100 billion capturing this once-in-a-lifetime opportunity in AI. And the recent $15 billion investment along with NVIDIA into Anthropic, giving the company a value of over $350 billion. And all of this CapEx spending is ballooning out of control. But here's the scary part. According to Deutsche Bank, the US economy would already be in a recession if it wasn't for all of this AI spending. So AI CapEx spending is literally propping up US GDP growth. It isn't hype money anymore. This is actually the lifeline of the S&P 500 and by extension, the US economy. This leads us to the core of the problem. If AI CapEx slows down, that means that earnings is no longer going to be growing, the stock market is going to go backwards, the US economy plunges into a recession, leading to a tightening of global liquidity. And this is exactly what makes it risky. And in this report by JP Morgan, looking at the build out of data centers, you could see they estimate that it can go up to $5 trillion and in some cases $7 trillion. When you think back to the number, the Mag 7, which makes up 40% of the S&P 500, only brings in $1.7 trillion. So this is about 3 times the cost of all of those companies bring in all of that revenue. And the report summarizes it perfectly right over here. It says that with $650 billion of revenue, giving a 10% return on all of that build out, that's the equivalent to every iPhone user paying $35 and every Netflix subscriber paying $180 a month. So we can see why people are having a lot of concern with this huge spend on AI and some of the earlier valuations. To understand how interconnected the money flow is between these AI companies, I looked at this report by Bloomberg right over here. When we first take a look at it, you could see that this is a complex web of different companies investing the same money into each other. But in today's video, I want to break this down and go deal by deal so that we can understand what is happening. So let's examine some of the select deals in this complex web of AI deals. Let's start off first with NVIDIA and OpenAI. So here's NVIDIA right over here with OpenAI. Earlier this year, NVIDIA says they'll go and they'll invest about $100 billion into OpenAI. So what does OpenAI do? They turn around with that same money and they purchase GPUs, the chips from NVIDIA. NVIDIA goes and books that down as revenue. So the second deal is OpenAI inks a $300 billion massive deal with Oracle. So here's OpenAI. You'll see them come up a lot. Here's Oracle right over here, a cloud provider. So what happens is in that $300 billion deal, Oracle gets a huge amount of revenue, so it books revenue onto its book. What does it supply OpenAI with? Well, it provides OpenAI with their cloud infrastructure and upfront costs so that they don't have to build any data center. What does Oracle do with that money? Well, it turns around and it buys GPU from, you guessed it, NVIDIA. So the next deal is NVIDIA buying $6.3 billion of services from CoreWeave. So here it is. Here's NVIDIA, here's CoreWeave right over here. They go and they purchase that $6.3 billion. What is CoreWeave's core business? Well, what they do is they go and they purchase GPUs in bulk from NVIDIA. They build out their data centers and they rent those data centers to guess who? OpenAI and companies like that. The even more interesting part of this deal, if you go right over here onto the 13G, the filings with the SEC, you could see right over here, here's NVIDIA. And if you look down, they actually own 7% of CoreWeave. So by NVIDIA investing into CoreWeave, they are essentially paying themselves for booking that revenue. So the next deal is OpenAI agreeing to pay CoreWeave $22.4 billion. So here's OpenAI and CoreWeave. They pay them that money, that $22 billion. That $22 billion from CoreWeave is going to flow right back to NVIDIA buying their GPUs. And you guessed it, NVIDIA is going to be investing in OpenAI. So you could see why people are skeptical and they're a little bit more concerned of this circular financing that's flowing around between and among the companies. So the next deal is OpenAI agreeing to deploy billions of dollars into AMD. Recall that AMD is NVIDIA's direct competitor. They're number 2 in the market when coming to producing chips. So if you look at the deal right over here, here's OpenAI, here's AMD. They deploy billions of dollars into AMD. What do they get back? They not only get back GPU chips, but they also get equity into the company. Now, even Jensen Huang said that he was very surprised of this deal. If you look at this deal closely, you could see that they're getting up to 160 million warrants worth of AMD shares, giving them a 10% ownership into their direct supplier. And of course, the US government sees all of this going on at the same time, cites national security concerns because they're in an arms race against China to become the number 1 in AI. So they take a 10% stake in Intel and then they claim a 15% of all sales of NVIDIA and AMD chips overseas. And of course, we saw this recent news with OpenAI completing its restructuring and Microsoft having $130 billion into its profit wing, worth 27% of the stake of the entire company. So what we're watching and witnessing is not a new form of capital coming in. It's actually some recirculation within that AI economy. So you can't really blame people for being skeptical about the illusion of growth within the AI boom in industry. And we get people like Michael Burry from The Big Short. You remember the guy who shorted the financial crisis of 2008, coming out and calling this AI bubble, being skeptical about revenue recognition, and calling it a fraud right out. Now, we all know that Michael Burry has a short position. He's announced it, but who knows what will happen in the near future. So another problem besides all of this circular spending is that where is all of this debt going? So in this part, we're going to talk about the SPV problem, which is where all of this debt is being hidden in plain sight. So let's first define what SPV is. So they're special purpose vehicle. They're basically a legal entity that allows you to finance specific projects and holds the debt off of the main company's balance sheet. So a very good example of this is xAI raising $20 billion from NVIDIA and other investors. You can see that NVIDIA invested $2 billion into this deal, with Jensen talking about being happy to be able to invest in Elon's company. So if we take a look at the fine prints of this deal, it's $7.5 billion of equity, $12.5 billion of debt that all goes into the SPV. The SPV turns around and buys chips from NVIDIA, and then xAI books those renter chips from the SPV. So I always understand these concepts a lot better with diagrams. So here's xAI, here's NVIDIA. They want to do this deal, but they can't do it directly with each other. They do it through this SPV. Now, it's much more advantageous because NVIDIA can invest their $2 billion. The rest of the investors put money in, and there's the debt. But all of that is tied to the SPV. None of that debt ever shows up on xAI's books. So what happens is that the SPV will go and buy that chip, those GPUs from NVIDIA. So booking revenue to NVIDIA. Remember that NVIDIA invested this money and now booking the revenue. And then xAI right over here goes and rents, then leases those GPUs, those chips. So all of that equity and especially all of that debt is basically hidden at a site from xAI's books. So the demand for compute power is real. The demand is there. But the financing of these deals make them look bigger, make them look safer, and make them look more attractive. So this is what they mean by the debt is being hidden in plain sight that you may not see on first glance. So at the center of all of this is OpenAI, the leading AI company and also the leading AI customer as well. If you take a look at their profile, even though they're a private company, they're valued at $500 billion, but they're only booking $13 billion of revenue in terms of the projection. Now, if you think about it, OpenAI at $13 billion of revenue has went out and committed $1.4 trillion of spending, and that sounds ridiculous. Now, if you take a look at this interview right over here.
OpenAI's revenues are still a reported $13 billion in 2025. And Sam, on your live stream this week, you talked about this massive commitment to compute, right? 1.4 trillion over the next 4 or 5 years with, big commitments, 500 million to NVIDIA, 300 million to AMD and Oracle, 250 billion to Azure. So I think the single biggest question I've heard all week and hanging over the market is how can the company with 13 billion in revenues make 1.4 trillion of spend commitments? And you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just enough. People are. I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself. Including myself.
People who talk with a lot of breathless concern about our compute stuff or whatever that would be thrilled to buy shares. So I think we could sell, your shares or anybody else's to some of the people who are making the most noise on Twitter, whatever, about this very quickly.
You can see from that interview that Brad asked him a very legitimate question. Now, like all other CEOs, I thought he should have explained it by saying something along the lines of, you know what, we're the fastest growing company. We hit 100 million users first, and now at 800 million users, this is why. But he chose not to and got extremely defensive. But you could see that with this valuation, and given the commit to spending, it's about 108 times revenue. Now, to see why that is so astronomical, imagine yourself running a small business and bringing in $50,000 a year. If you only bring in $50,000 a year and spend 108 times, that's about $5.4 million of spending. So you could see why Brad was curious and why he asked a legitimate question, because all of us would be wondering, how does the math work out? So is all of this AI spending and valuation out of control? Is this really the dot-com bubble 2.0? So back in the early 2000s with the internet bubble, there was tons of companies with no real earnings, everyone chasing the next big thing, and there wasn't demand at all. So a prime example of this was Pets.com. They were one of the hottest business during that time. But if you look at their revenue, they only booked in $5 million of revenue while spending 10 times that amount. You could see that this was a recipe for disaster, and almost every balance sheet looked like Pets.com because there was no real demand that was there. And during that time period, hundreds of companies were popping up like Pets.com that ultimately resulted in the bursting of the bubble. If you take a look right over here, you can see that the NASDAQ from 2000 to 2002 lost almost 80% of all of its gains. And you can see it very clearly right over here that at that same time, all of these companies like Pets.com literally went to zero. We can see and learn from the lessons from the dot-com bubble that even great companies like Amazon during that time suffered a catastrophic loss.
In the year 2000, when the internet bubble burst, Amazon's stock in a very short period of time went from $113 a share to $6 a share.
Of almost 99% of their valuation dropping from $113 to $6. And we could see right over here, going into July, August of this year was the first time that the tech companies exceeded 1/3 or 33% of the entire S&P 500. And the last time that happened was back in the 2000 dot-com bubble that bursted. And more than 50% of the companies did not survive this collapse. And of course, everybody thinks that it'll be different the next time around. Now, one of the things that distinguishes the dot-com bubble from today's AI bubble that we're seeing is we actually have real demand and applications. We can see that the number of users on OpenAI has exploded to over 800 million. If you compare that to the peers, you can see Gemini having more than 650 million users, Grok about 65 million users, and Claude about 20 million users. And we could see right here there are revolutionary applications of AI, just like Google's DeepMind AlphaFold being awarded the Nobel Prize in Chemistry for protein folding. And what it took biologists, scientists, and doctors to do within 50 years, they were able to achieve that with AlphaFold within light speed. And this is a huge leap in implication for medicine and science alone. It will help us understand a lot of different rare genetic diseases, how to fight cancer, how to approach drug testing, just a whole slew of application. So what are we as investors and everyday people supposed to do? Number one is that I think it's critical to recognize that there's some bubble behavior within the market and not just the technology itself. As we've seen today, there's a lot of circular deals that are going on between 6-7 companies where the money is going within circles and then also the debt is being hidden out of our sights. We can certainly believe and see that AI will change the world, but at the same time, the spending is unsustainable. Those two are not mutually exclusive events. Number two is watch the CapEx growth in spending. It's one of the leading indicators. When CapEx starts to flatten out, you know that this bubble behavior is finally coming to an end. And don't assume that our accounts invested in an index fund is actually diversified from AI. Remember that every 40 cents out of the dollar that you put in is going straight into this AI. So one certainly has to be cautious when looking at the economy and investments overall. If we look at the P of all these companies, you could argue that you're actually buying the company at a better valuation today than what they were 5 years ago. And if you wanted to make a comparison back to that 2000 dot-com bubble and burst, you could see right over here the four horsemen, which is Cisco, Microsoft, Dell, and Intel back then, were actually trading at 80 times their PE before the bubble bursting. And if you compare that to the Mag 7 today, the Mag 7 is only trading at 36 times the PE. And if you were paying attention this week with NVIDIA's Q3 earning calls, they blew the numbers out of the waters. But it wasn't so much the numbers, and it was what Jensen said. You could see right over here, he said Blackwell sales, their newest and latest chip, are off the charts and cloud GPUs are sold out. Compute demand keeps on accelerating and compounding across training and inference, each growing exponentially. So he's saying that there's a lot of real demand that's there. We've entered the virtuous cycle of AI. The ecosystem is scaling fast with more new foundation model makers, more AI startups across more industries and more countries. AI is going everywhere, doing everything all at once. You've never seen the CEO of the largest company of the S&P 500 in the world making this bold and this aggressive statement. So every time I get nervous about a bubble that's happening, I remind myself this chart. Over the past 36 years, we had over 30 events, major events like the dot-com bubble, the financial crisis in 2008, the wars that have been going on, 9/11, recent wars, COVID and everything else under the sun. You could see that with powerful and great investments into companies, like let's say, for example, Amazon, they will emerge from even a major crash. So in my mind, those 1,300 companies and those unicorns out there, there will be a lot of casualties of this AI bubble. But at the same time, if you're invested for the long term and you're into good companies and you're not doing degen stuff, I think you will come out on top. And the last thing is I want you to look over here. You can see that since 1949 to now, the bull markets tend to last 5 years, whereas the bear markets last for about a year. If you miss out on the bull market, you're missing about 250% gain, whereas the bear market is only minus 31%. Now, if you try to time the tops and bottoms, 99% of us will not be able to do it. So for me, I'm sticking with long-term valuable assets that will grow over time. And I'm not so worried about, what's the next AI bubble, the next tech bubble that's going to blow up. So that was a lot of things to go over today. I hope that you guys learned something and you enjoyed today's video. So if you do, consider liking the video, subscribing, and I will see you guys next time.